Hi, everyone. This is Tim Melvin of the Tim Melvin Deep Value Letter and Banking on Profits newsletter, coming to you from what is just an absolutely gorgeous Sunday early afternoon down here in Central Florida. Getting ready, of course, for the big football games and all that later on today. But it was, for all the noise and everything going around events in Europe, it was a relatively quiet week. The S&P 500 was down 1.28% by the end of the week. And the all-world URTH index, which you might have expected to really get slapped around by the Swiss bank moves, was only down 0.31% on the week. And the QABA index of small community bank and thrift stocks was down 1.77%. Lots of trading between the bid and the ask going on there, I suspect, because there wasn't really a lot of moves in the smaller bank stocks that I track from week to week. Yesterday, got the new edition of Barron's. Cracked it open, and of course it's part one of the roundtable. I love the roundtable every year. I don't make forecasts, but I sure get a kick out of reading everybody else's. And this the people in the roundtable every year: Bill Gross, Mario Gabelli, Felix Zulauf. There's some really smart folks giving you their ideas, opinions, and thoughts on the market and economy in the year ahead. And of course, there's usually a whole bunch of stock picks, and sometimes I even find ones that are cheap enough for me to actually buy. So far, that's not the case. But in the first part of the roundtable, they kind of all talked about their view of the economy and the world going forward in 2015. And I have to tell you that it's right up there with James Montier's hideously expensive comments, in that their outlook and forecasts are a little scary. And these are some pretty smart folks. I'm not going to trade on it. As always, I think that trading on forecasts and predictions is a great way to get separated from most of your money relatively quickly. But all of them, I don't want to say they were outright bearish, but nobody was bullish. Felix Zulauf kind of summed up the mood of the meeting. He said that Europe is in a crisis. And in his opinion, the ECB is doing everything wrong, and he sees Asian growth slowing quite a bit, more than people expect. And he thinks all of that filters over into the U.S. economy, and we don't grow as fast as some of the economists are forecasting. Now, again, I don't trade on it, and I don't make a lot of predictions, but that's kind of in line with my feelings about 2015. I think 5 years, 6 years into the recovery, I think everybody is expecting just a little bit too much in 2015. We'll see. Bill Gross also has a not positive opinion of the economy and the markets going forward. He thinks that interest rates are going to be a lot lower than most people expect. Everybody thinks the Fed's going to raise interest rates. I, along with Mr. Gross, do not see the type of economic activity that's going to justify any large interest rate increase in 2015. We may get a surprise going down the road, but at this point, I have to say that I don't see it. Nobody, even Abby Joseph Cohen of Goldman Sachs, who is usually wildly bullish no matter what's going on in the world, she says that her official forecast is a return of 3-4% plus dividends for 2015. I think that's the lowest annual forecast I've ever seen her make. Nobody is looking for the market to go up much more than about 5% in 2015. So given that almost all forecasters are bullish, I have to say that a 5% forecast by all these guys is probably a little bit bearish for the stock market in 2015. We got a couple stock picks from Merle Whitmer and Mark Faber. None of it really caught my eye. We'll see what comes up next week when the rest of the predictions start coming out. The Swiss bank moves just absolutely shocked the market. It was just back in the fall that the Swiss bank said they were going to continue intervening to keep the Swiss franc reasonably priced to help their export industry. Well, this week they just let it go. They just stopped buying euros to support the exchange rate, and the franc flew up so over 30% during the week, caused quite a bit of volatility in the markets. It was a shocking move. Several currency trading firms are no longer with us as a result of this, and FXCM has had to go to Lucadia for a $300 million bailout as customer losses vastly exceeded customer deposits, and there's very little chance that they're going to track down a lot of that money and have the retail investors that lost hundreds of millions this week in foreign exchange to pony up and meet the margin call. Don't think it's going to happen. At least one big hedge fund has been taken taken out of business by the move. They lost over $800 million by apparently being long the euro against the Swiss franc. Probably a little bit too much leverage involved there as well. There's a thought, and I tend to agree with this, that the Swiss franc are doing this because the Swiss bank, I'm sorry, are doing this because they anticipate an aggressive bond buying and stimulus program when the European Central Bank meets next week in Frankfurt. I think they have to. The markets expect it. Markets are pretty much demanding that we start to see some aggressive stimulus action on the part of the ECB in order to get the economy cooking in Europe. I don't think that the stimulus programs are going to do anything to get the economy kicking. They really didn't in the U.S. I think the best we can say about the U.S. stimulus programs as far as economic activity is they may have helped keep things from getting a lot worse than they actually did, but nothing to stimulate serious economic activity or create job growth was achieved via the stimulus programs, in my opinion. I think the Eurozone will be the same, but if they do not step up to the plate and announce serious stimulus action in bond buying when they meet on the 22nd, I think the European equity markets are going to be in big trouble. We will see some fierce selling if they remain relatively inactive in printing money and lowering interest rates across the continent. We have a list of safe and almost cheap enough stocks at the ready. So if we get that type of downside volatility in Europe during the course of the week, we'll be ready to take advantage of it and reduce the cash levels in our international value portfolio. So now we had a great example this week of what I call value at work and why I never get too excited about short-term moves in stocks or what a stock's doing from day to day. There's a company out there called Courier Corporation. This is a ridiculously boring company, okay? They publish and print books. When you walk into a Home Depot, all those books that they're selling up near the front of the place, the garden and home books, those are Courier Corporations, many of them. They do some religious printing, some educational publishing. Real boring company. Nothing exciting about this at all. We bought the stock back in 2011. It was trading at about 60% a book, paying out a significant portion of their cash flow. So it had a great dividend yield, which was what really caught our eye, was that combination of a discount to book and a nice dividend payout. It's not a growth business. There's not really any way to reinvest funds in that business these days in the face of all the e-reader competition. So they just paid out the cash flow. We bought it in 2011, as I said, on August 19th was the first time it appeared in a real money column, and I started buying it that day after the publication. Stock just kind of drifted around. We collected the dividends. We owned it. It went up a little bit. Nothing exciting going on with this company until Friday, when it was announced that Quad Graphics is going to buy this company out at $20.50, combination stock and cash deal. So I went back and looked. We'd owned the stock. We had, our usual 1% position. Nothing big, nothing exciting, just another stock in the portfolio. But now the takeover is $20.50, folks. We paid $5.63 for this stock back in 2011, giving us, as of today, a 43% compounded annual rate of return from this quiet, sleepy little stock. Each year, most of my return in the value portfolios comes from stocks that I bought 3 or 4 years ago. Generally, the ones for the first year or so after I buy some of these stocks, they go sideways. Some of them even go down. The way we approach this is a much longer time frame, and we get lots of stories like Courier Corporation. Boring with little stock, nothing exciting going on. We bought it really cheap, and at some point it catches somebody's eye, and the stock is bid up or bought out. It's a patience process, but I will tell you, I'll take a 43% compounded annual rate of return in my stock holdings every day of the week and well beyond. So it's a game of valuation and patience. You have to think like a private equity investor and not like a short-term trader, and you too can reap the benefits of deep value investing. It does tend to work out very well over time. You just have to be extraordinarily patient. Now, I've been putting together a review this week. We ran a screen using the screening program that Nate Tobik of Complete Bank Stock Data puts out, completebankdata.com puts out. It's a nice screening tool. And we found 122 banks that traded below book value with less than 500 million of assets. Now, that was our cutoff because Jonathan Briggs, who's a bank M&A specialist at a firm called Chaffee and Associates, recently penned an article that said, look, if you have less than $500 million of assets, in this environment as a bank, you're simply not going to be able to squeeze out a profit and survive. And most of the M&A activity that we are seeing at this point in time is banks with less than 500 million of assets. These are very small banks. The market caps are ridiculously low. One of the ones that we were looking at and putting together yesterday's review had a $7 million market cap. They're incredibly illiquid. They trade kind of by appointment. You have to match a buyer to a seller. So you just put a limited order in on these things, and you patiently wait for a seller to pop up and drop a few shares, and that's how you build a position. It takes a long time. It's, you're not going to short-term day trade these things, because when you want to sell, you're going to have to wait for a buyer to pop up. So it's not for everybody. I certainly love it. I'm a big fan of the old Warren Buffett saying that if you're not prepared for the stock market to be closed for the next 5 years, you should not buy any particular stock. You should be prepared to own it at least that long. I always am, particularly with these little banks, because more times than not, my exit here is going to be a takeover. The executives running these little banks know they've either got to do a merger of equals and get up over that 500 million, headed towards $1 billion or more in assets, or in the new era of banking, they're just not going to be able to earn more than the compliance and regulatory costs. They pretty much are in a position where if they don't have this super strong specialty niche market in a particular city or town, they need to sell their bank in the next year or two. It's going to happen. We've got 122 of these little tiny banks. We can't put them in the Banking on Profits main portfolio because, our several hundred subscribers are not going to be able to buy them. Not everybody's going to get a fill on these stocks. Our own buying activity can distort the price and make performance look better than it really is. I have no interest in doing that. But I do think that investors in these bank stocks that adopt a private equity mindset over the next 3 to 5 years, and these real small ones, are going to make just a ton of money. Now, we're starting to just kind of review and outline these things in the regular weekly review that we put up for Banking on Profit subscribers. And I did 6 banks yesterday. They all, of the 6, traded for less than 65% of tangible book value on average. The non-performing assets for most of them were in line. One had some problem assets and had a NPA level as a percentage of total assets. That was, a little high for my taste, but the management was doing a lot to bring it down. They brought it down by over 50% over the last 3 years. So things are getting better in it. They're successful. That bank is actually probably going to be a huge winner. It also puts more pressure on them because they're getting attention from the regulators who are making their life difficult, and they're asking what they're doing to clean up this portfolio, operating under orders, and that creates exhausted executives who really want to get out. And if they can get an offer of book value or more, they're gone. So anyway, this is a fascinating project. We're having a lot of fun with it. Subscribers are going to make a ton of money with this, in addition to what they make in the regular Banking on Profits portfolio, in my opinion. If you think about this, they're going to sell. Most of these banks are going to sell. They're going to sell for more than book value because nobody's going to swap their bank out for less than the tangible asset value. So if we're buying them at less than 65% of tangible book value and selling at book or more, we've got a potential upside in all of these stocks over the next year or two of 60% or more. So that's pretty exciting, and that makes me willing to put up with the fact that they are illiquid and hard to buy. I love the illiquidity factor. Most investors love liquidity. I love illiquidity. It means I'm not competing against the institutions. My stocks aren't going to get knocked around by high-frequency traders and computer traders, and the bank will trade based on its own fundamentals and takeover appeal to larger banks in the area. I will happily accept illiquidity for the potential of a 50 to 60%, say 12 to 18 month upside with very little day-to-day volatility and price risk in these particular stocks. We're going to get a spreadsheet together. I'm going to have to do it apparently by hand. It's going to be a pain in the you-know-what. But we'll get that out to subscribers sometime in the next week. If you're not already signed up, get in touch with me or customer service, and we'll get an offer together for you so it makes sense for you to jump in and enjoy these really large, low-risk potential profits that I see in this space over the next 12 to 18 months. So anyway, it is Sunday afternoon. We have some exciting football games. Basically, I'm going to cheer for Green Bay and I think the New England Patriots, because I have more family and friends that are fans of those two teams. So I'll get more Super Bowl party invitations than I will from a Seattle Indianapolis matchup. Should be great football games. I'm going to spend as much of the day as I possibly can on the couch with the new Christopher Russo Gilly book on Peter Cundall called Routines and Orgies. Looks fantastic. The reviews are good. The same author that did the original book on Mr. Cundall. There's always something to do, and that was a great book full of wonderful information, not just on value investing in markets, but on life itself. And at some point today, I have to undertake a task that I've been putting off simply because I dread it. My daughter's getting married in March, and she wants me to help pick out the song for the father-daughter dance. Now, I'm terrible at this stuff, so if any of you guys have a really unique, great, guys or girls, father-daughter dance song for a wedding, email me at tmelvin@gmail.com with your song ideas. I would really appreciate the help because I'm awful at this stuff. Anyway, should be a great week coming up. We've got one more day left to the long holiday weekend, so it'll be a shortened trading week. Things in Europe will certainly make it interesting, and we're just going to plug away working on our list of tiny bank stocks for big profits in 2015. This is Tim Melvin from down here in Central Florida, and I'll talk to you guys next week.